Welcome into this training, how to save 20% on your tax bill as an entrepreneur. I'm Alex Engar here on the right. It's my business partner, Will Boyd, there on the left from CEO Finance Academy. Our mission is to help entrepreneurs earn more, keep more, and grow more profit as they spread their mission in their business. And in the next few minutes, I'm going to show you the two business tax concepts that have saved us over $20,000 a year in taxes. That is not a misprint. But want to give you a warning. The following is meant for educational and entertainment purposes only. You should talk to someone who actually knows what they're talking about, aka a tax professional, before making any important tax decisions in your business. I'm just a business owner who's implemented this stuff in our own business, and we help others do it as well. And from everything that I've learned, I want to tell you, you probably don't understand taxes at the level you need to as a business owner. I didn't either. And so this is part of our progression towards truly becoming CEOs in our business. And we want to share with you how to decrease your tax bill legally and ethically. So let's talk real quick as an individual. What happens with income tax? Well, there are three kinds of income taxes that you pay. We're not going to get super deep into this, but at a basic level, you're going to pay federal income tax, you're going to pay state taxes, and you're going to pay Social Security and Medicare taxes. Okay, so that's if you were a W-2 employee. Those are the three main taxes that you'd be paying. Okay, well, as a business owner, you pay three kinds of tax plus maybe a couple extras. You still pay federal income tax, you still pay state income tax, and then you pay something called self-employment tax. I'm not going to get really deep into self-employment taxes and what it is, but I am going to show you how to save a bunch on self-employment taxes by the end of this. Then there are some other taxes as well that sometimes you pay as a business. Sometimes there are state business taxes for states like Tennessee that actually do tax your business. Sometimes there's city taxes as well for certain cities that charge a lot for your business. And then there's payroll taxes if you have employees. And the business itself usually does pay those. But what most people don't understand is that you as the individual are the one who pays the bulk of the taxes even when you are a business owner, okay? We're going to look at why that is. So let's look at just for a minute. You've got your business here. Maybe you're an LLC, and then you've got you, the individual. Now, a big reason why you want to have a business in the first place is for the legal protection, right? That's why we set up LLCs, limited liability companies, so that if you have a customer that maybe gets upset, maybe they fall and break an ankle at your business, they, if they sue your business, they can't sue you personally. They can't reach into your personal assets, or at least it makes it harder to do that. So there's some really good reasons for legal protection to have an LLC, but let's talk about taxation and how it works. So you are taxed when your business makes the money. I want you to think of it like a pair of financial pants, okay? You're wearing a pair of pants with two pockets, and one pocket is your business bank account, and the other pocket is your personal bank account. Well, you are taxed when your business makes the money. Okay. The IRS doesn't see this pair of pants and say, oh, you made money in the business, so we can't tax you yet. No, it's the same pair of pants that you're wearing. It's just a different pocket. So they say, hey, you made money in the business. Great. Doesn't matter if it's over in the business account or if you've already moved it to your personal account, you're getting taxed on that money as the individual. Okay. So here's how the IRS really sees your business. You bring revenue in to your business. You have expenses that go out. And then we've got what's called profit left over, right? It's revenue minus expenses equals your profit. That profit passes through to you as the business owner, and it's reflected in your personal taxes that you pay, okay? You might have some other income. Maybe you have a spouse that has a job, or maybe you have a job, or you have another business. You might have some other sources of income. Those all pool together, and then the IRS says, hey, we'll actually let you take out some deductions, right? So things like there's now a qualified business income deduction. There's the standard deduction. You might itemize your deductions. We aren't getting super deep into this, but just know there's ways that the government lets you not pay as much in taxes. And that gives you what's called your adjusted gross income, okay? Just follow me here for a minute. If you don't understand this at a deep level, it's fine. This is review for kind of high level how taxes work. Once you have your adjusted gross income, the government says, okay, this is what you owe based off that adjusted gross income in taxes. Then they also throw us another bone and say, hey, there are actually some tax credits that will directly decrease the amount of taxes you need to pay. And whatever is left over, they say, okay, that's what you need to pay to Uncle Sam. Okay. Now this is for the United States. For my Canadian or European or Australian friends, it might work a little bit differently for you, but this is how it works in the States. Okay. So the IRS says you are taxed based off your net annual profit in the business. Like we showed, revenue minus expenses equals profits. Now stay with me here because I'm going to show you something so cool. So for example, if you make $100,000 in your business, you have $25,000 of expenses, then they'll say, hey, you had $75,000 of profit, and you would pay taxes on that $75K in profit. Now we know that there are things like deductions and other things that will knock that down. But a lot of times business owners think, oh no, so I should always try to get my profits to zero so I don't pay taxes, right? Wrong. That is absolutely not the approach that you want to take in your taxes, okay? You want to profit as much as possible, then deal with the taxes the right way using the right strategies, some of which I'm going to show you today, because profit means money in your pocket. So why should you care about profit? Well, you actually want to keep money. I'm assuming that the business isn't just there so that you can make a bunch of money and then spend it all. You might someday want to retire. You might want to be able to buy a house. You might want to be able to afford food for your family, right? You want to have profit in the business. And I'll tell you, as an entrepreneur who's now bought rental properties and we're building our own house right now, boy, the bank absolutely wants to see profit from your business. So please don't go down the rabbit hole of thinking that you just need to rack up as many business expenses as possible to decrease your tax bill. It's the wrong way to do it. You want to make as much profit as you can and then deal with the tax strategies that we're going to show you in order to not pay as much. So remember, we've made all of that money, all that profit, and then we're paying our federal income tax, our state income tax, and the self-employment tax, and then maybe city or state taxes and payroll taxes. Cool. So follow me up to this point. So now we've got this map that we can look at and say, okay, I know that I'm being taxed based off the profit from my business. So let's look at a couple different ways to decrease this profit from the business without actually having to spend more money necessarily. Okay, so how do you legally reduce what you owe in taxes? Well, this is what you're here for. The IRS gives us these different deductions that we can say, hey, in the business, I know I can take certain things as expenses. So the IRS gives us this guideline. It must be an ordinary and necessary expense to the business, and they leave that pretty open to interpretation. Now, this next slide is absolutely for entertainment and education purposes only, but here's a couple of options of things that you may be able to deduct as expenses in your business. Now, this is not a comprehensive list, and some of these things on here may be wrong. Hey, they may even get you thrown in jail. Who knows? You need to go talk to an individual tax advisor again. This is just how we look at taxes in our business and how our advisor has helped us to see things. So for example, your cell phone bill. Have you ever thought that a business would need a cell phone? If the IRS were to audit you and you said, yes, I have a cell phone bill for my business, is that an ordinary and necessary business expense? Well, it'd be pretty hard to argue that it's not. What about an internet bill? What about a percentage of your home being used as a home office? I've even seen some people say, hey, you might even be able to use some of your landscaping as business write-offs, or a security system in your home if you have a home office. Now, all of these things, again, you should talk to a tax professional to help get real insights on what you can write off. This is just to start getting your wheels spinning. There's even the opportunity, if you work at home, if you have a home office, to write off a percentage of your mortgage interest in certain cases. Or ones that we love that a lot of people will use is if you need to buy a new computer and you're going to do it anyway, wonderful. That's something that you could have as a business expense. Office supplies, coaching, business books. There's very specific rules on travel and when you can travel for business and what it looks like. Certain health insurance costs even. If, for example, if you employ a spouse in the business, their health insurance cost could be a business write-off, and that health insurance could cover your family. There's really specific rules around all this, so you need to do your own research and find someone who's good at what they do. But the point of this is if you're already spending the money on the thing, it makes sense to learn if you can put that thing through the business and count it as a business expense. The wrong way to do this is say, gosh, it's coming up to the end of the year. I've made a bunch of profit and I don't want to pay taxes, so I got to go buy a bunch of crap. No, don't go buy a bunch of crap that you don't need, that you wouldn't already spend for. Just put the stuff that you're already buying, figure out what can be piped through my business as a business expense, and have a tax professional help you make these decisions together. Cool. So that's one of the first things is we look at what can I increase in business expenses to reduce my profit that are expenses that would already be spent anyway. Okay. If you're already going to buy the thing, it might as well be a business expense as long as you can legally do it. But that's not really why you're here, because you probably already knew that. You probably had seen some of those examples before. Here's the real juice of how you can save 20% on your taxes, because I promised you this at the beginning. And just getting business expenses racked up might save you 20%, but if you spend too much through the business, it might also leave you cash poor at the end of the day. So let's look at the totally next level strategy. If you had a normal LLC structure, this is kind of what it would look like. You'd have your LLC, and the profit that goes through that passes up to you as an individual. So let's say you profited $100 in a year through your LLC. Okay, so maybe you made $150,000 and you had $50,000 of business expenses. So the IRS says, okay, there's $100,000 of profit that's passing through to you as the individual, and you're going to be taxed on that. Okay, so if I were to pay taxes on that, here's what it would look like. I've got my federal income tax. Let's just say, for example, that's 24%. I know I'm simplifying here a little bit. Your state income tax, let's say it's a 5% state income tax. That's what it is in my state. And then your self-employment taxes that you need to pay are 15.3%. We'll kind of round it up to 15%. So all the taxes that you would pay for your LLC might come out to $44,000, okay? Now that might shock you and be like, gosh, that is super high. Yes, there are deductions and things that will knock that down, but let's just simplify for now, okay? We've got our $44K in taxes. Well, let's look at what a next level S Corp structure would look like. For a very specific kind of structure, your business can decrease taxes incredibly efficiently, and I'm going to show you how. So you still keep your LLC. You don't change that at all. You still have that down there. That's your operating business where you're actually making money and you're spending business expenses. But then you create a second company. It's a holding company. And this holding company is an LLC taxed as an S Corp. Shout out goes to Brad Gibb at Cashflow Tactics for teaching me this strategy. And I've implemented it myself now over the past couple of years and helped a lot of clients set it up for themselves as well. What this actually does is it allows you to be taxed as both an employee of your business and as the owner of your business. And so we get taxed differently. We're going to see how in just a second. But now, instead of making your profit go directly from your LLC up to you, the individual, it passes through this holding company. And you might be asking, well, Alex, why don't I just make my LLC the S Corp? Why don't I just change it to that? Because that's what most tax professionals will tell you to do. And the reason is twofold. Number one, there are certain business requirements that you have to have as an S Corp that get a little bit trickier in your operating business. So things like you need to have a salary for yourself and any owners. So if you have other owners in your business, if you have a partner, it makes it a lot more complicated to do this at that LLC level. For example, if you want to open up another business someday, you definitely don't want to have to open up another S Corp and go through all the hassle of operating multiple S Corps and having multiple salaries from those. And so this allows for expansion as an entrepreneur to have one holding company that's an S Corp, and then all your other companies below it are LLCs. And in fact, your holding company owns your interest in that LLC, meaning that I no longer am the direct owner of my LLC. My holding company is, and I'm the owner of my holding company. Okay. So now what does this do to us from a taxation standpoint? Well, as part of an S Corp, you have to pay yourself a W-2 salary, okay? Meaning you become an employee of the business, which actually makes sense because in your business, you are operating as both an employee and probably making ownership type decisions. And so in this way, you're saying, well, I want to get compensated as an employee and we want that salary to be as relatively low as possible, but the IRS has some guidelines. So it usually ends up being somewhere between 30 and 50% of your total profit needs to be paid out as a salary to you, okay? So somewhere in that 30 to 50% range. This is why a tax professional needs to guide you through this decision, okay? So there's 40K that can be coming through. I just picked sort of a middle number there. 40K that can come through as W-2 salary. The other 60K then gets paid to me directly as a dividend. And I'm getting compensated here as the owner of the business, an asset that I own, my holding company, my businesses. My asset goes up in value, and so I get to take a dividend as part of that. This dividend is you're just being paid a little bit differently. It's not being paid because of the work that you've done in the business. It's being paid because you own the business, and so it's taxed differently. So let's look at how it's taxed here. So the W-2 side of things, I still pay my federal income tax, okay? I'll still pay my state income tax, and I still have to pay my self-employment tax. I'm paying both sides of that self-employment tax. So my taxes there as a W-2 employee don't change. And if I'm taking $40,000 and breaking it into those percentages, I end up paying $17.6K in taxes on the W-2 side, okay? But now comes the cool thing. Pay attention here, okay? You ready for this? Sit down. When I get paid as a business owner and I'm taking a dividend, I do not have to pay self-employment tax. So look at what this does to my tax situation. I still have to pay federal income tax. I still have to pay state income tax, but I'm not paying self-employment taxes on that income because I am being taxed as an owner and not as a self-employed individual anymore. So that tax burden on that side of the equation, then I pay $17.4K in taxes. So I'm still paying both of these sides of the tax equation. I'm paying W-2 taxes and I'm paying taxes on my dividends, okay? But if we look at this now, before when we said our LLC only, we paid $44,000 in taxes, right? So if we looked back here was my $44K in taxes. But then right here, I'm only paying $35,000 in taxes as an S Corp. That is a difference of $9,000 in taxes that I legally do not have to pay, which equates to a 20% reduction in my tax bill as a business owner. How incredible is that? And when I say there's $9,000 less that you pay in taxes, that is literally $9,000 in your pocket to keep at the end of the year. So this is how, as a business, we decrease our tax bill by about $20,000 a year. So it's about $10,000 each in our business that we don't have to pay because there's two business owners. It's about $10,000 each that we don't have to pay in taxes. That's money that directly gets to go to my family for whether it's buying our next rental property, whether it's saving up for our degenerate crypto investing, whether it's for if you want to pay off bills or you're paying off loans. That's money directly in your pocket. Okay, so now let's talk. That sounds amazing, Alex. How can I do that? What are the downsides of it? Well, the downsides are you have to set up a salary for yourself as a business owner. So you need a software that can auto pay you every month and auto take out your salary and your tax withholdings. I use Gusto, and I have a team that set it up for me. I have to take some official meeting minutes as part of an S Corp. There's some pretty specific guidelines on what you need to do on a regular basis. It's not a ton of extra time, but just a few extra hoops to jump through so that I actually act like an S Corp owner. There's some extra bookkeeping because now I have an extra entity, right? I have an extra LLC taxed as an S Corp. And then there's some extra accounting. I have to pay taxes as, I have to file taxes for an S Corp, and there's a little bit of extra expense there. So you might be looking at this and saying, well, gosh, I want to do this right now, or maybe when do I do it? And this is a great question. So really, when it makes sense to switch to an S Corp structure is once you're making about $50,000 in profit per year or more, okay? Not just revenue, not just total income, but $50,000 in profit in your business or more per year ends up making this really worth it to you, okay? I hope that this just blew your mind as you looked at this whole strategy here. And one simple change that you can make into your structure in order to save 20% on your taxes without having to spend any extra money in doing business write-offs. But you combine that along with the S Corp structure, and it becomes really, really powerful. Cool. So if you want our help to help you set up your business financial systems, get a profitability plan, and really make sure that you have your head on straight about where your business finances are going, here's what it would look like for us to work together. If this has been really helpful, you're like, gosh, I really want to dive in, figure out my own business together. We have a program called CEO Finance Academy. This is our premier program. It's a hands-on business finance planning and systems setup program designed to get hands-on with you about your business, help you figure out where's my profitability at? How much do I need to be saving for taxes? How do I make sure that I'm paying myself consistently, but not paying myself too much and not paying myself too little? We're going to get a complete financial system together as we sit down over 3 months to really dial in your business finance systems. This is best for people who are already making $5,000 a month or more in their business and are ready to grow fast. Okay, for a lot of people who come into this, they're working on hiring and scaling, and they know, gosh, I'm not sure that I'm really profitable enough to scale yet, or I'm scaling pretty quickly and I want to make sure I stay profitable throughout it. That's a perfect fit for CEO Finance Academy. Okay, this is kind of what it looks like. It's 12 weeks of business finance education, hands-on coaching, and accountability. This is not a passive course that you sit down and go through. This is a very hands-on program where I'm actually sitting down with you. You're getting in there with our profit coaches to look at your business specifically and how it ties into your personal wealth growth. Okay. So we have at the beginning, we'll have a one-on-one deep dive business profit game plan call where you'll sit down with the profit coach and look at all of your numbers in the business. If you don't know your numbers yet, we're going to guide you to get the right ones and start to feel comfortable knowing what to measure in your business. Then after that, we'll have 3 one-on-one business finance review calls where we'll actually sit down every month and look at what was your profit from last month? What were your expenses from last month? And making business decisions together, these CEO level decisions about what you're going to do with your money, okay? There's a private community for our CEO members where you can ask questions, you can get feedback, share wins along the way. There's an online business finance roadmap where it's very short coursework to sit down and get your numbers together. And it actually just helps to prepare you for your one-on-one deep dive calls. There's a community of like-minded business owners who are all in here making these kinds of decisions together and really getting a handle on their finances as they scale. And then you get access to our trusted financial team members for things like bookkeeping, accounting, and this long-term wealth growth. This is CEO Finance Academy. If you want in or you want to see the details of it, you can go visit ceofinanceacademy.com/details. There's a video there explaining the program in detail, kind of showing what it would look like for us to help you in your business, what things would we focus on together. You'll fill out a brief application so we can get to know your business and see if we might be a fit. And then you'll book a one-on-one CEO financial blueprint call. And we'll sit down together, you and I, and see where you at in your business. It's a no pressure call, not sitting on there to hard sell you on something. It's to look at, well, where are you really at? Where do you want the business to go? And what does the game plan need to look like? What does the financial blueprint look like for you moving forward? If it's a fit for us to work together and help you accelerate that game plan, then we'll absolutely look at what that would look like together. If not, then I'll just tell you straight out. We'll say, hey, doesn't make sense for you right now, but here's what you need to go do to improve profitability, to keep growing the business moving forward. Cool? Go check out ceofinanceacademy.com/details. And if this was useful as a training, please let us know. We're going to be pumping out more of these. Thanks. Go take action on this stuff now. And hopefully we'll see you on your finance blueprint call.